Today we're going to talk about IRA contribution deadlines. It is tax season, and as you know, the deadlines are fast approaching to file your taxes. This year, for 2022, the deadline to file your taxes without an extension is April 18th. That is also the deadline to contribute to your Roth or your traditional IRA this year. The contributions can be made for 2021 up until you file your 2021 taxes. IRA contributions are regulated by the IRS. The total contributions for your Roth and your traditional IRA together are limited up to $6,000 a year for regular contributions currently. Now, this is subject to change and has changed in the past. But for 2021, and as we already know now, for 2022, you will have a limit of $6,000 for your regular contribution. If you want to make contributions for both tax years, since you do have the entire tax year to make it, if you wanted to apply some to 21 and 22, make sure your tax preparer knows that and you keep good records, but that is for sure allowed. If you are over 50, you can make a catch-up contribution. This allows you to contribute an additional $7,000 for the tax year. Now, your IRA and traditional IRA contributions must be made from earned wages. Now, there are other types of accounts for retirement that can be set up for self-employed people, such as the SEP or the Simple, and those have different limits and usually are based on the total revenue or income that self-employed person was able to generate. Rollovers. If you have a qualified account, such as a previously established 401k, Roth IRA, or traditional IRA, there are two types of rollovers you can make. Direct. This would be from custodian to custodian. You would never take possession of the money. You would simply have whomever is handling your 401k send it to your newly established IRA or a previously established IRA to a new IRA. If you move one of those to a Roth IRA, there are tax consequences, and I recommend you talking to your tax advisor about that prior to making that decision. Indirect, it means that you actually temporarily take possession of the money. By current law, you have 60 days to put the money back into a qualified account and not be subject to income tax. Again, keep good records on this and consult your tax preparer about how to account for that on your tax forms. Now, neither of these, direct or indirect, impacts the ability or limits you from contributing to an IRA or a Roth IRA. So if you have a 401k that your employer is contributing to, that's fine. If you make a rollover, that's fine. You can still also make a new contribution for the current tax year as long as you don't exceed your limits. Now, we can talk about the deadlines. As previously stated, you have until tax day, April 18th this year, but usually April 15th, to make a contribution for that tax year. Now, I recommend you talk to your tax professional since you have all the way up until the day you file your taxes to make that contribution. You might find that it's advantageous to go ahead and make a contribution for the previous calendar year for this year's taxes. Your tax professional can help you with that. Obviously, the more you contribute, the higher your deduction for this portion of your tax credit. Now, after you file your taxes, unless you file an extension, and after you've made your contributions, you will get a 5498 letter. Since you have all the way until April 15th or 18th this year to make your contributions, you won't get this form in time to file it for that calendar year's taxes. This is for your record-keeping purposes only. So it's important that you keep your records, and this is a backup documentation should you ever be audited. Again, it is not required to have this form in your hands before you file your taxes. Likely as not, you will have already filed your taxes, and this is just to back up the information that you provided to the IRS about your rollovers or your initial contributions. And again, you can make a contribution early in the calendar year, and at that time decide, if you've not already exhausted your limit, whether you want it to go for the previous tax year or the current tax year. There's no reason why, if you haven't already contributed for the previous calendar year and you're getting ready to file your taxes, that you can't contribute the full amount, in this case for 2021, and also for 2022 at the same time. Just keep your records very clear. Now, you should keep these papers in case you're ever audited or if you need them for other backup documentation. You will not need those to file your taxes. In fact, you won't have them in time to. So just make sure that you're keeping good records. And if you have a good CPA, he can help you keep these records as well. Here's how you get a hold of me. Let me know if you have questions or comments or suggestions for future videos. Until next time, thank you.